Here is a question that divides Canadian investors more than almost any other. Would you rather have a portfolio that pays you $375 per month in dividends right now, or a portfolio that pays you nothing right now but is on track to be worth $1.2 million more in 30 years? That is the real trade-off between dividend investing and growth investing. And most Canadians pick the wrong one for their situation. Not because they made a bad decision, but because nobody clearly explained the actual trade-off. The dividend investing camp points to monthly income, stability, and the psychological comfort of being paid while you wait. The growth investing camp points to total return, the empirical evidence that a globally diversified equity ETF like XEQT has historically delivered better total returns than a Canadian dividend-focused portfolio over a 10-plus year horizon. Both camps have data on their side. Both strategies work. The right choice is not about which one is objectively better. It is about which one is better for you, right now, at your specific stage of life. Here is what this video will prove. For a 28-year-old Canadian in the accumulation phase, growth investing likely builds more total wealth over 30 years. For a 62-year-old Canadian approaching retirement who needs monthly income, dividend investing likely produces a better quality of life and a more sustainable income stream. The answer depends on one key variable. By the end of this video, you will know exactly which strategy is right for your situation, which Canadian ETFs execute each strategy, and how to use the TFSA to maximize either approach completely tax-free. For a 10-plus year time horizon, a global equity ETF like XEQT or VEQT has historically delivered better total returns than a Canadian dividend-only portfolio, according to Wealth North's April 2026 analysis. The S&P 500 alone delivered approximately 15.73% annualized in Canadian dollar terms over the 10 years to December 31st, 2022, driven heavily by technology sector growth that Canadian dividend ETFs have minimal exposure to. VDY, Canada's most popular dividend ETF, produced a 12-month trailing yield of approximately 3.53% in October 2025. Its total return, including distributions, has been competitive with the TSX overall, but materially below XEQT over longer periods. The key insight: dividend investing does not inherently mean lower total returns when dividends are reinvested through DRIP. The S&P 500 dividend aristocrats, companies with 25 or more consecutive years of dividend increases, have historically produced returns competitive with or exceeding the broad market because dividend growth is a proxy for business quality. In Canada, a comparison between low-yield dividend growth stocks like Alimentation Couche-Tard and high-yield payers like BCE showed Couche-Tard exceeded BCE by more than 18% in total return and over 11% in risk-adjusted return over the holding period, according to Starlight Capital's 16-year study. The underperformance of Canadian dividend ETFs compared to XEQT over the last decade is largely attributable to sector concentration. Canadian dividend ETFs are 50% to 60% financials and 20% to 25% energy, with almost zero exposure to technology. The Magic Pants Dividend Growth Watch List, the list, reported an average YTD dividend increase of plus 4.6% and average YTD price gain of plus 4.6% in 2026, showing that quality dividend growth stocks can deliver both income growth and capital appreciation simultaneously. Action step: look up the total return, not just the yield, of any dividend ETF you hold, compared to XEQT's total return over the same period. Both calculations use $500 per month inside a TFSA with DRIP enabled. Strategy A. Growth investing. $500 per month into XEQT at 10% average annual return. Zero monthly income during accumulation. All growth is capital appreciation. Strategy B. Dividend investing. $500 per month into VDY at 7.5% total return, 4.5% yield, plus 3% price appreciation, DRIP enabled. Monthly income from day one, growing every month with DRIP. The comparison at year 30. XEQT, $987,052 portfolio, generating $44,417 per year at 4.5% withdrawal. VDY, $631,390. Portfolio generating $28,411 per year. Gap, $355,662 more portfolio value and $16,006 more per year in retirement income from XEQT. But the VDY investor received income throughout. $131 per month in year 5, growing to $2,368 per month by year 30. That income has real value, particularly if it prevents panic selling during downturns. The honest conclusion: growth investing builds approximately 56% more total portfolio value over 30 years on the same monthly contribution. It requires holding through 30% plus corrections without panic selling. Dividend investing builds less total wealth, but generates income throughout, which has psychological and practical value the numbers do not fully capture. Action step: plug your monthly contribution and time horizon into both scenarios. The gap between the two final portfolio values is the cost of choosing current income over maximum growth. Inside a TFSA, both dividend income and capital gains are taxed at $0. The dividend tax credit is irrelevant inside a TFSA because both income types are already completely tax-free. The only factor that matters for after-tax returns inside a TFSA is total return, not income type. Outside a TFSA, in a taxable non-registered account, VDY's eligible dividends at $70,000 Ontario, taxed at approximately 7.6% annually. Dividend tax credit applies. XEQT's capital gains, taxed at approximately 26.76% effective rate, but only when you sell. Dividends create a taxable event every year whether you want the income or not. Capital gains only create a taxable event when you choose to sell. For high-income Canadians, the ability to defer capital gains taxation by holding is a meaningful advantage. The U.S. withholding tax issue. VDY holds Canadian stocks. No U.S. withholding tax concern in TFSA. XEQT holds approximately 45% U.S. stocks, but primarily generates capital gains rather than significant dividend income, so the withholding tax drag is minimal. For a dedicated U.S. dividend ETF like VGG, always hold in RRSP, not TFSA, under the Canada-U.S. Tax Treaty. Account placement priority: TFSA, VDY or XEQT, both equally tax-free. RRSP, U.S. dividend. ETFs, VGG. No withholding tax under treaty. Non-registered, VDY. Dividend tax credit applies. Action step: if you hold VDY or XEQT in a non-registered account, calculate annual tax paid on distributions. Moving inside TFSA saves that tax immediately and permanently. Dalbar's annual study shows the average investor dramatically underperforms the funds they invest in because they sell during downturns and buy after recoveries. In 2022, XEQT fell approximately 15% to 20% with no income paid. For investors with limited emotional resilience, that experience is extremely difficult to hold through. In the same period, VDY continued paying monthly distributions. Receiving $324 per month while the portfolio was temporarily down made it significantly easier for many investors to hold. The income provided a psychological anchor that prevented panic selling. The yield trap. Investors focused on yield can be drawn toward high-yield stocks, whose high yield reflects underlying business stress rather than financial strength. A 9% yield often means the stock price has fallen significantly, reflecting expected dividend cuts. Wealth North's May 2026 analysis identifies this as the biggest risk in dividend investing: chasing yield without analyzing total return, payout ratio, and dividend sustainability. The high yield versus dividend growth distinction, CDZ, tracks Canadian dividend aristocrats, companies that have raised dividends for 5 or more consecutive years. These companies provide lower initial yield but growing income and often better long-run total returns than pure high-yield strategies. Action step. Have you sold investments during market downturns in the past? If yes, the monthly income from dividend investing may be worth the lower expected total return, because staying invested is more important than the theoretical optimal strategy you cannot hold through in practice. The one key variable: do you need income from your investments right now? Or are you still in the accumulation phase? If you are in the accumulation phase, typically under 55, do not need investment income. Growth investing, XEQT or VEQT in your TFSA, is the optimal choice. The empirical evidence is clear. For 10-plus year horizons, globally diversified equity ETFs have historically delivered better total returns. The $987,052 at year 30 versus $631,390 translates to $16,006 more per year in retirement income. Caveat: you must hold through 15% to 30% drawdowns. If past behavior suggests you cannot, add VDY as a satellite for psychological support. If you are transitioning to or in retirement, typically 55 to 65 plus, need investment income, dividend investing, VDY or XEI in your TFSA becomes the primary strategy. Monthly distributions replace employment income. TFSA withdrawals do not count as income for GIS purposes, a critical advantage for lower-income retirees. No need to sell units at depressed prices during market downturns. The hybrid strategy for most Canadians, 5 to 15 years from retirement, 60 to 70% XEQT continued growth, 30 to 40% VDY, growing monthly income, psychological anchor, natural transition to retirement, the life stage transition, age 25 to 40, 90%, XEQT/10%, VDY age 40 to 55, 70%, XEQT/30%, VDY age 55 to 65, 40% XEQT/60% VDY age 65 plus, 20% XEQT/80% VDY. Action step: answer the one key variable honestly. If no income needed, XEQT dominates. If approaching that need within 10 years, start transitioning toward VDY gradually. Let's come back to where we started. $375 per month in dividends right now, or $1.2 million more in 30 years. If you do not need investment income right now, the $987,052 at year 30 from XEQT produces $44,417 per year versus VDY's $28,411. $16,006 more per year in retirement income. The higher total return from global growth investing, compounded over 30 years inside a tax-free TFSA, is the right choice. If you need investment income today, or you know from experience that you sell during market downturns, VDY's monthly income arriving reliably every month is the right choice. Staying invested through every downturn is worth more than the theoretical optimal strategy you cannot hold in practice. For most Canadians between 30 and 55, 70% XEQT for long-run total return, 30% VDY for monthly income and psychological stability. The empirical evidence is clear. For a 10-plus year time horizon, a globally diversified equity ETF like XEQT has historically delivered better total returns than a Canadian dividend-only portfolio. Dividend investing is not automatically superior to total return investing. The best approach depends on whether you need income now or are still growing your portfolio. Both strategies work. Both compound inside a TFSA at 0% tax. The question was never which one wins. The question was always which one is right for you, at your stage, with your psychology, and with your specific income needs. Now you can answer it.